G'day and welcome to Motley Fool TV. I'm Adam Surplice, General Manager of Motley Fool Australia, and joining me tonight remotely is our Chief Investment Officer, Scott Phillips. G'day, Scott.
Adam, g'day. Good to be with you remotely. Good to be with our viewers and our members remotely as well. Kind of cool, mate. We're trying out a new platform. It's all happening at the Motley Fool.
Yeah, that's right. We've got a bit of feedback and it worked on Zoom, but hopefully with YouTube we'll reach a few more people and it's a bit easier to receive as well. So just as a disclaimer that we have to give every time we do this, we cannot give personal investing advice. All of our general advice will be general in nature. Bear that in mind as you watch tonight. Also bear in mind that if you have any questions, you can throw those into the chat and we will endeavour to answer them. We also have a few questions that we've had from members during the week in our via email, and we'll get to those as well. So moving on, this is a historical week in the US, of course. Kamala Harris has exploded out of the blocks in the wake of Joe Biden stepping down. The US presidential race is still wide open though. Lots of uncertainty in the air for the US. What does it mean for markets both in the US and here, Scott?
Yeah, such a great question. Apparently Kamala is brat. Adam, did you know what brat meant? When I was a kid, being a brat was bad, right? Did you know brat was good these days?
Well, I've done my learning. I've consulted with my teenage kids and it's a good thing.
Apparently, it's mate. The TikToks are going off too. It's all happening. Look, she has exploded out of the blocks, as you say, and it really has. It's changed. I won't say change the game necessarily. It's certainly changed the narrative really significantly. And look, we're not here to give comment on the politics necessarily, but you know what? There's an old cliche. Cliches tend to be cliches because they're right more often than not, or at least they're commonly accepted. And the markets hate uncertainty is one of those ones that everyone says, and we kind of think is true. It kind of pretty much is because what markets tend to work on expectations. I've said many times, we might talk about this later, I call earnings season expectations season because it's not really about the profits companies deliver. It's what those profits are relative to the market's own expectations. Now, let's take that to the US election. The market expected one of two old white blokes would win the election, both known quantities. There was a firming view that Donald Trump was racing ahead, particularly after the assassination attempt a couple of weeks ago. And so there was kind of that sense of the market thought it knew what was going on. Since then, we've actually seen, as you say, mate, a real shake-up. You know, Kamala's absolutely shot out of the blocks a million miles an hour. The cool kids are all talking about it. Look, I don't think it changes all that much. What I will say is we don't know yet how or if her policies as the potential president would change from Joe Biden's. Now, she was his VP, or still is, of course, his vice president. That remains the same party, in theory, the same ticket. Will it be meaningfully different? I don't think we know yet. We have seen Joe Biden in the US as president, for example, whack 100% tariffs on Chinese electric vehicles, for example, as one way he was trying to shore up support for jobs at home, largely through a political lens rather than a financial one, quite honestly. Tariffs make things more expensive for people. It's terrible policy, but it's good politics sometimes when you get to dress it up as saving jobs. What Harris will do in that context, not just about EVs, but in general, we don't yet know. There is a view that she may have to come out harder line than Joe Biden on some policy areas to try and win back some of those people who might see Donald Trump as an alternative. In terms of individual policies, the good thing for Australia is we are seen as, you know, on Team America for better or worse. So when we think about, for example, rare earths or what used to call mineral sands, most of those are in China. And so companies and countries with deposits outside China are kind of getting favorable treatment. The so-called Inflation Reduction Act that was unveiled in the US was great for companies like Linus, for example, here. So how Kamala Harris, if she is elected president, or even just from a policy perspective in the meantime, how she changes, if she does, any of Joe Biden's policies is really the key insight and the key focus for markets. On a broader macro level, it does come down a little bit. We'll talk about this, I know, in a minute. The economic settings for the US, is it going to be more prosperous? Is it going to grow more quickly? Are we going to see interest rates there change as a result? At the moment, it seems like a bit of a storm in a teacup. I should say too, mate, this is really important because people tend to either worry about politics impacting markets, or some people who are kind of a bit more partisan like to think their party is great for the market and the other party is terrible for the markets. Some data that's been done in the US in particular, while we're talking about the States, shows there is almost zero correlation over time between the party in power and the subsequent performance of the stock market. Sometimes Republicans are great for markets, sometimes they're bad. Sometimes Democrats are great for markets, sometimes they're bad. Probably the best thing we can do is ignore the politics, at least from a market's perspective, from an investing perspective, for now at least. If and when there are changes, of course, we'll let our members know what's going on. But for now, should be a case of nothing to see here.
Yep, and hopefully that answers Stephen's question. We did have a question from Stephen via email, asking exactly what you've just said. Should you be standing on the sidelines, and is it safe to invest before November? I knew what the answer would be, and true to form, you brought it home.
Can I share a quick anecdote, mate, on that one?
Sure.
In 2016, before Donald Trump was elected, there was one particular journal, I won't name them because it's not fair, there's not about a name and shame exercise, who basically said that she was going to put half of her portfolio in cash just in case Donald Trump won. Now, in the event, Trump did win, and the markets actually did really well. Not because you could have foreseen it, but that was the reality, right? And even on the day of the election, when it came to light that Trump was going to shock everybody, Hillary Clinton, of course, famously was supposed to win. Trump comes over the top poll-wise, ends up taking the election. Our market fell, what's that, 2 or 3% on the day, and then recovered most of that by the end of the day and was up the day after by the time that had been factored in. What we can tend to do as investors, we've got to be really, really careful, right? We tend to fear downside more than we cheer upside. We feel the pain of loss more than we feel the joy of gain. Now, what that can do is people will look at this and say, I don't know what's going to happen. Maybe I should sit on the sidelines in case it's bad. And that's understandable. The problem is that equally likely is maybe I should be investing in case it's good. And that we don't tend to do that second bit. We tend to kind of take the fear bit first of what if it goes badly? Maybe I should sit on the sidelines. You could have spent the last 25, 30 years worrying about what if the next headline becomes fact? What if the markets fall? And you would have missed out on a stonking return over that 30-year period. I've talked about this a lot. 13 times your money would have risen in 30 years, according to Vanguard, over that period of time, while you said, what if the dot-com bust continues? What if there's a double-dip recession after GFC? What if? And by the way, some of the what ifs we didn't expect were things like COVID. No one had planned for that, and yet it happened. And so I think you've got to take that zoom out perspective. As you say, mate, I'm going to say it anyway. I'm going to say it again just to really push it home. But it's really important to remember, don't just look at the what-if downsides. The market goes up over time. So mathematically, you're better off being invested than not, on average, right through that period of time. Don't let the scary headlines stop you investing.
Yeah, that was a big learning experience for me. I was actually in our head office during that time in 2016. Our head office just across the Potomac River from Washington, D.C., right in the thick of it. And yeah, that election result was absolutely palpable. The reaction, the visceral reaction from people living in that part of the US was really something to, really memorable. And like you say, the market kind of shrugged it off and went gangbusters after that. It's definitely something to remember. Anyway, closer to home and closer to the here and now, Australian inflation figures due out next week, RBA interest rate decision the week after. Hate to ask you, but what's your expectation for those numbers and beyond?
And unemployment out last week too, by the way. I'll start with last week if I can, mate, because it helps contextualize it. I'll set up very quickly. We know interest rates are going to be largely about, well, the RBA is supposed to do two things, right? Full employment and price stability. So unemployment, inflation, those are the two things they pay most attention to. Not exclusively, not only, but those are the two things they're their two marquee sets of numbers. And what's really, really strange and really unusual is last week when the unemployment rate went up to 4.1%, tempting to look at that and go, okay, the unemployment rate rose. That must be meaning the economy is slowing. That must be good news for interest rates. If you want them to come down, most of us paying a mortgage want that to be the case. So you kind of start with that, right? Unemployment up, the economy therefore is weaker, therefore the RBA might do something. Here's the really unusual thing about unemployment rising that we don't often see. Unemployment rose, and yet there were 50,000 jobs created. So hang on, you've got unemployment going up, more people in theory unemployed. That's what that rate would normally tell you. And yet there were more people in jobs. We created more jobs. The economy isn't cooling. It's continuing to grow. Businesses are continuing to hire in advance of what they hope are growing sales and profits. What's going on there? Now, the answer for those who are a little bit nerdy like me is what we see is more people looking for work. So there were 50,000 jobs created, but I don't know the actual number, but 70 or 75,000 more people in the labor force looking for work. Maybe 2/3 of those roughly got a job. The other 25, 30,000, whatever the number was, couldn't get a job but wanted one. That's why the unemployment rate went up. Now, that doesn't happen very often. It's happening right now specifically because we've got a really, really rapid rate of population growth. Now, that is immigration plus natural births. In this case, it's labour force, right? So we're talking about people over 18. So a kid born yesterday is not adding to the unemployment queues, but someone who's left school and is now looking for a job, they are absolutely adding to those unemployment numbers, or at least the pressure on the labour pool. And so we're seeing this really weird situation where a rise in unemployment that normally would be a sign of economic weakness or slowing is actually not that at all. It's more a sign of more and more people in the labour force, both looking for a job and in work, than was the case the previous month, despite those jobs being created. So that's the first thing. Not as good as you would like it to be when it comes to interest rates. Very good, of course, those 50,000 people who now have a job who wanted one. So that's the unemployment starting point. Let's go forward to next week then. We'll skip this week. Not much is happening this week. Actually, it's a really, really empty week for economic data. Next week, by the way, the Olympics will be starting, so that's always good to look forward to as well. But the big one for boffins is going to be the inflation number. Now, this is the monthly inflation read. As I've said to our members before, and I'll say it one more time just to make sure everyone's clear and across it, the ABS now puts in two inflation data sets. The first is their quarterly one. They've been doing that one for decades. They take a quarter's worth of data, price data, compare it to the previous year, the previous quarter. That's the rolled gold, kind of gold standard inflation read. The other one is the monthly one. Now, that's only, maybe it's 3 years old by now, maybe 2, something like that. They introduced that basically because the market said we want more data more frequently. And so the ABS pulls together about 70% of the data pool for the quarterly one. So the monthly one is not only more regular, it's not as complete as the quarterly, just because it's harder to compile that data on a 28 or 30-day basis. So that comes out next week. It's expected to be down from 4% the previous month to about 3.7%. That's the consensus. Now, again, is that good or bad? Well, great that it's falling, 4 to 3.7. Everyone would like inflation to be going down. Not great in the sense that still means prices are rising by 3.7%. So that's not great. And also that 3.7 is still meaningfully outside the RBA's target band of 2 to 3. Now, Governor Bullock, Michelle Bullock, spoke at an AFR conference. What day is it? Wednesday? I mean, Tuesday, I think she spoke, or Monday afternoon, maybe Monday night, about the inflation circumstance. She called out a couple of things. Firstly, she said construction costs remain really high. The RBA is worried about the cost of construction. We know construction on top of electricity or energy generally and insurance have been the three stickiest parts of the inflation read. And she's basically saying there's no good news there yet. The other thing she said was basically we know things operate with a lag. In other words, what they do now won't have full effect for probably 6 to 9 months is the generally accepted wisdom. So whatever they do or don't do now won't have an impact until kind of, February, March next year. And she's saying the balance of risk still remains very, very tightly balanced. In other words, she's well and truly on the fence about what happens next. There's no likelihood of a cut anytime soon, short of an economic collapse, which would be terrible. The question is hold or raise. She's certainly not laying out her cards, playing them very close to her chest at the moment. When it comes to interest rate, mate, very, very, very unlikely, I think, that we see a meaningful move next month with a big asterisk, which is it's not going to be the data itself that says things are terrible. It'll be the data that says things aren't improving quickly enough. Last time they met 6 weeks ago, they now meet 6 weekly, of course. Governor Bullock basically said, look, when inflation is now outside our range of expectations, they had this glide path of kind of, top left to bottom right as inflation comes down. It's not coming down as quick as they want it to. If they see that being still too far outside, they may want to give us a bit of a kick in the guts just to help things drop off again. But for now, it remains very, very, very evenly poised.
Sure. Okay. So it could turn out to be a fairly boring month next month in that regard.
Or not.
But it won't be.
Yeah.
If nothing else, we've got earnings season coming up. So
yes.
Give us a quick rundown. Exactly what is earnings season and what are you expecting to see?
Nice, mate. So ASX, if you're listed on the ASX as a company, you're obliged by the regulator, ASIC, and ASX, the exchange, to provide your earnings to the market. In other words, you have to announce publicly what happened twice a year. On the half year, every 6 months, and on the year, every 12 months. So generally speaking, and for most Australian companies, they run the financial year, by the way, as a company, you can choose whatever you want. You could run from the 14th of March to the 13th of March the next year if you wanted to. They don't, but you could. You can choose whatever you want. Most companies choose the tax year because it's just easier, right? You're putting together one set of books. You have to slightly different set of books for tax purposes. But if you can do all the work at the same time each year or each month, you want to do that if you can get away with it. So most companies run July 1 to June 30. On the ASX, you must release your earnings within 2 months of the end of the half year and the full year. So we don't have to work too hard to do the maths. June 30 full year, August 31, yes, is 2 months after the end of June. You must have your report, your earnings announced to the market, listed on the ASX, sent to shareholders within 2 months of that. Now, the reality is they could have started on July 1, but if you've worked for a large company or for a small company, getting the accounts together just takes ages. You do all the final, the balances, you do all the reports, you write up the commentary, you go to the auditors, they do all their stuff. And so companies generally tend to take about a month to get that sorted. So we could have companies delivering their earnings already. There's nothing stopping them. They could do it today. They could have done it yesterday. Most of them, though, will take about a month to get themselves sorted. And you tend to see earnings season actually a real thing, by the way. It's just what we call it. Start about the 1st of August, give or take, and run right through until the 31st of August. So that's what it is. It's our chance to see and kind of fully audited financials, right? The profit and loss statement, the statement of cash flows, the balance sheet, statements of changes in equity, if you want to know. That's the fourth one that accountants and analysts like to talk about. They're the 4 statements companies produce. They must produce a director's report, remuneration report. They must produce a list of the top 20 shareholders. So you get a whole lot of information you get to grab and say, awesome, now I get to find out what's going on for my company or what I'm interested in investing in. And that's why it's important. That's why it's worthwhile. The great news, if you like this sort of stuff, as we do, is you get it all, and you get it all in black and white, really easy to do. The bad news, the downside, there's probably 1,800 odd companies on the ASX, and they're almost all going to put out their numbers in the space of 30 days. Take out 4 weekends out of that, and you're kind of talking about 20 or 22 business days when everything hits the exchange. Now, if the company's balance date, by the way, is outside the June 30 date, some won't report in that cycle, so there will be some later, but 99% of them, probably 98% of them, report during that period. So that's what earnings season is. That's why we care. It's why it's important. It's the one chance you get to see everything about a company, or at least everything they're obliged to report. And that's a really great time to see some of that data. Now,
yeah, very busy time here for, I was just going to say, all leaves cancelled here at Motley Fool, right? Very busy time for you and your,
exactly.
your team of analysts.
Yeah, we talk about drinking through a fire hose, and that's kind of what it's like. You just kind of, and it's one of the, you start the day, particularly about the 2nd and 3rd week of August, they're the busy ones, and you kind of open your email client of a morning, and they start to pop in, and they keep coming and keep coming and keep coming, and you kind of feel this weight kind of getting heavier and heavier on your shoulders as the morning goes on. You try and desperately get through it and try and keep on top of it. It can be pretty daunting from time to time. We've got a great team of analysts, of course, at the Fool, 9 or 10 of us who are dedicated to doing that all month. So we've got some great people doing it. Really fantastic team, which is awesome for me and for you and for our members. But yeah, a lot of work going on. In terms of what we expect about earnings season, mate, this is going to be really interesting. I'm glad we talked about rates first, because we've seen now, what is it, a year and a half, maybe almost 2 years now, of rate rises. That has kind of slowly bled through into the economy. We know for the first year or so, not much happened. And we know that because the economy kept growing, the RBA kept increasing interest rates because they weren't having an impact. Now, I think we've talked about this in a previous Motley Fool TV, the household savings ratio was over 20% as we exited COVID. In other words, we were saving 20% of our incomes every month. Why? Partly because the government was throwing money at a lot of people and a lot of businesses. Partly because there was nothing else to spend the money on. We were at home. We weren't traveling. We weren't buying anything. We're sitting there going, what do you do? I don't know. I guess we'll put the money in the bank. So that was coming out of COVID. And the RBA had to soak up all that excess capacity out of the economy. When you go from saving 20% of your income, your mortgage goes up 5, 10, 15%. Okay, maybe you're saving 13% of your income or 10% of your income. In other words, you're still saving a heap. It hasn't changed your consumption habits. It's just changed the savings rate. And it's not until savings comes down, it's now under 1%. And so that's when the rubber hits the road, right? When people go, I've got no more savings to use here. I'm not saving anymore from my monthly paycheck anyway. I'm going to now have to start changing what I spend money on. And that's why, that's almost exclusively, in my view, why it's taken so long for the RBA's rate increase to actually have an impact. They had to get us up to a point where it started to properly hurt. Now, sounds pretty awful, sounds pretty cruel, right? But that's what they're trying to do. They're trying to reduce demand. If they're not reducing demand because we're just saving less, they're having zero impact on the economy. And that's why they, in hindsight, should have gone harder and should have gone faster, but certainly why it's taken this long. Now, why I set that all up is because this is probably certainly the first full year, maybe even the first 6-month period, the last 6 months, where that's really been super painful. We've seen retail sales decline. In March, we saw that happen. We saw individual retailers' sales fall. Baby Bunting famously dropped massively on their, effectively, people just simply chose to shop elsewhere, buy less, buy cheaper product. So excuse me, that's the earnings season we're facing. Is what do we expect now? What's happening? We saw Mighty Craft, the craft brewer, actually go into voluntary administration on Monday, just gone, so 2 days ago. And largely, yes, the craft beer market is hyper crowded, right? There are so many of them. There's more IPAs than I've had hot dinners. But if you look at that, yes, the category is tough. Yes, it's concentrated, but consumers are changing their habits. We're not drinking the numbers of craft beers as we were. We're not paying the prices. Why? Because the economy is getting tougher. And so when we think about that 6-month and 12-month period we've just seen the end of, we really will start to get some very real senses of what's happening to demand, what's happening to prices. Are they having to discount their prices? Is it reducing their margins? How are they able to pass on or absorb the higher costs of their own business? Staff costs, fuel costs, transport costs, raw material costs. Those things are going to have to come into the numbers. So this is a really fascinating one. The other thing, by the way, mate, this is the first clean year, clean in inverted commas, we've had since 2019, which excludes the whole COVID palaver. So going into fiscal 2020, which ended in June 2020, we had the first 5-ish months, 3 months of COVID. Then the next full year, more COVID. The year after that, there wasn't the same COVID impact, but what we saw was the bounce back or the hangover. So online businesses, for example, had a terrible year after that because people went back to the shops. Some physical retailers had a great year because people went back to the shops. But looking at like for like, as an analyst, we want to say, what's the underlying earnings power? One of my favorite phrases. What's the underlying earnings power of some of these companies? We haven't seen that, a clean set of numbers without a COVID impact since fiscal 2019. We're now 5 years on. We've just finished fiscal 2024. That's what companies will be reporting on when it comes to next month. But it's the first time we get to see that. And even then, we can't compare it to a clean year because last year wasn't clean. So it's a really, really interesting one. We're going to have to earn our money, really dig into the data and find out what's actually going on when we exclude any of those COVID impacts from the numbers.
Yeah, sure. And you mentioned the second week of August is where you really start to get busy. And one of the companies that I know that you're looking forward to reports on the 14th of August, and that's Pro Medicus. Yeah. So what is it about Pro Medicus that you're so excited to see?
I can give this one away, mate. It's actually a recommendation of Motley Hidden Gems service I used to run way back in the day. I was the first lead advisor, co-lead advisor with Joe Mager, who used to work with us. And that was a very long time ago now. It's been a long time recommendation. This has been an astonishing business. I want to say, and I could be wrong about this, it's been one of the top performing companies of the last decade. I think it was maybe one of the top 4 or 5 companies last year, share price wise. It has been an absolute stonker of a share price performance. Now, the PE is astronomical. I'm pretty sure it's still in triple figures. It is huge. But what's fascinating about this business is the business model has been amazing. Their ability to sign on new customers to multi-year deals basically means you're getting visibility of sales 2, 3, 4, and 5 years out. Very rare you do that, right? Woolly sales, you get a sense of it after they've happened. Pro Medicus has signed contracts with customers for 2023, 4, 5, 6, 7, 8. And so you get to see that happening as it comes. You got to look at what's happening there. This has been a remarkable success story because it's managed to not only convince its customers, this has become, I'll step back. Pro Medicus does advanced computerized data visualization of things like x-rays and scans. Brand new technology. In the past, you needed massive computers, huge files to view some of these things. Pro Medicus they bought a business actually that invented a way of using computer power to basically reduce massively the computer bandwidth required. And it meant that doctors and clinicians can see these scans literally on the mobile phone across town with a really, really low bandwidth requirement. It changed the game hugely. It's become the gold standard among that stuff. And so when you think about the way it's being used by medical centers and people like Johns Hopkins, like really top flight organizations are picking Pro Medicus up and saying, we want to use your product, Visage it's called. We want to use your product. It has done an extraordinary job. And sales are just continue to climb and climb and climb. It's one of those little engine that could kind of success stories. What we'll see is what their new contract revenues look like. We'll see how they manage to manage their costs, as I talked about before, and we'll see the operating leverage of this business. If it can continue to expand, can continue to grow, it'll absolutely justify the current PE. If it can't, that's the big question, right? Is can it continue to grow at that rate to justify the enormous faith that investors have in it. But it's been a remarkable story. $133 a share from memory last price. The guys at Hidden Gems did a great job when they recommended it. It was just super, much lower than this. It's been just a blowout success. Congratulations to the team at Gems, obviously, but on an outside basis, this is one of the big companies of last year. The question is, can it continue to get the growth we've seen? Decent chance it can, given success and the track record, but we'll certainly find out in a couple of weeks' time.
Yep, and there's another company that we'll talk about. It's actually a question in the chat from Hassan.
Nice.
Similar story, also a recommendation, I'll give it away, in Extreme Opportunities, and that's Telix. I don't know a whole lot about Telix, but I do know that it's been a similar story performance-wise.
I feel like I'm boasting on behalf of the team, but you know what? I'm going to. They weren't my ideas, right? So I get to just boast on behalf of the team. Hey, can I let members know that Hidden Gems is open too? Is that okay?
You just did.
Okay, good. There you go. So check your emails. You may, if you're not a member of Hidden Gems already. We are opening Hidden Gems at the moment. So no promises. The future won't be as good as Pro Medicus. It just can't be. It's been a stonking success. But Hidden Gems is open. Ed Vesely does a wonderful job running that service. So if you're keen on small caps, check that out. It's not an ad. It's not a promotion. It's not a promise. Just check your emails. A whole lot of terms and conditions and stuff. You know the drill. But have a look out for it, because it is really a great service. It's doing a wonderful job. So Telix. Yeah, Telix is a business that's trying to develop cancer drugs. It is one of those. I won't say moonshots, because it's not quite fair. It's in further stage. It's in stage 2 development. I'm waiting for some stage 3 approvals from memory. Trevor Machezi, who runs Extreme Opportunities, has done a wonderful job of this. He's recommended it twice in the last 12 months. I looked at the numbers this morning. Shares were down about 8% today, by the way, so I'll get to that in a second. But twice in the last 12 months, he's recommended it. The first one was up 91%. The other was 100.7% or something in the last 12 months. Again, like Pro Medicus, these aren't usual results. I'd love to think every stock did that well. It doesn't. But the other thing is, if you are in that sort of small cap or the higher risk game, you're investing specifically to find those next big things, right? Maybe Telix is it, maybe Pro Medicus is it. That's exactly what the guys are looking for. So it's kind of proof of concept in one way, not because every company's like it, but because if we get our track record right, our strike rate right, those sort of successes, when they come, just do wonders for your portfolio, for wonders for the scorecards. So that's why we're going for these ideas and why we want to celebrate them when they happen, knowing, as I said, and admitting that not every company will do quite as well. Telix has done an amazing job. The share price just up and to the right. Really, really cool. Trevor loves this company, mate. He's talked about it a few times with our Motley Platinum members. Certainly recommended it at Extreme Opportunities, as you say. The opportunity for these guys is to be able to have stage 3 trials passed and approved, particularly in the US by the Food and Drug Administration, and then become the standard of care for treating certain cancers. That is kind of holy grail stuff, right? Nanosonics, a different company we've also recommended separately in other services, has had that experience. It makes disinfected ultrasound probes and the machinery to disinfect those probes to reduce hospital-acquired infections. When you have the best solution, that's become the standard of care in Europe and America for ultrasound disinfection. Cancer drugs, same kind of thing. If you can be the gold standard, the primary choice, the top of the pile pick for curing cancer or treating cancer, that's what you're looking for. And Telix has a couple of drugs in the pipeline already, both existing drugs looking for broader uses and new potential drug candidates. If they can get a couple of those away, and the way drug kind of companies tend to work is the further you go, you start with stage 1, stage 2, stage 3, the further you get along that journey, the higher the probability you find something. There are no guarantees. This could be a very bumpy ride. Maybe it gets knocked back. Maybe it's got to do more work. Maybe it doesn't. Maybe it gets approved. But that's why the market's getting excited about Telix. And frankly, it's one of those companies. It's nice to do well by doing good. Yeah, it's nice to own shares in companies that have these sort of benefits, that do these sort of things for society. And Telix is one of those companies that's really desperately trying to find great clinical solutions. Trevor found this one early. It's done really, really well for him and for members of Extreme Opportunities so far. Again, no guarantees like Pro Medicus, but it's making every post a winner so far.
Yeah, great. I hope that answers your question, Hassan. I think that's a pretty ringing endorsement. So let's go to the other end of the market cap scale, and
Okay.
Alphabet and Tesla. They've actually delivered their earnings reports for this year. So what can we take away from those?
Yeah, really. So I should say I own Alphabet shares, and my son owns a fraction of a Tesla share. So I have a dog in both those fights, very different degrees. Let's start with Tesla. It's going through a really interesting phase of its kind of corporate life right now. Now we know the Tesla story, we know the Elon Musk story. One of the most storied companies of the last 20 years. Musk, just the cult of personality, the sheer force of will to create a car company. He didn't invent the technology or create the company itself, but to take that company from the idea of a car running on batteries to one of the biggest automakers in the world, one of the more, I think it's the most valuable automaker in the world, even after the shares fell in the last little while. It's just an incredible story. The challenge for Tesla from here, though, for shareholders, is to think about where it is in that market adoption cycle. I think most of us believe that one way or the other, electric vehicles are the dominant source of road transport in, pick your time frame, 10, 15, 20 years. Tesla may well be one that's doing particularly well. BYD, by the way, the Chinese company, apparently is the largest maker these days by number of electric vehicles. So I think part of the Tesla challenge for investors right now is it was first mover. It is the most profitable. It has done really well. The question is, how long can it continue to be the market leader? Maybe short term, maybe forever. How long can it maintain the stratospheric margins by car company standards? Again, who knows? How long can it continue to grow sales? And the grow sales bit is the challenge. There's been a lull in demand for EVs right around the world. And it's kind of that adoption curve, right? We talk about the Gartner hype cycle in other contexts. But basically, it's gone from a pipe dream to early adopters loving the heck out of this thing. It was the only EV maker on the block. It had to run, lots of doubters, by the way, while it did it. But built a profitable car company, which is really hard to do. And now what? And this is the hump it's trying to get over, is can it continue to grow from here? Or is it going to have to slow its growth rate down? Can it continue to bank the same margins it's had? Or is it going to become price competitive with other EV makers? And literally, not only BYD, an exclusive one, but think about everyone's doing it. BMW's doing it, Porsche doing it, Toyota's got a new 48-volt hybrid Hilux apparently coming. Everyone's now in the electric game. And so now Tesla's got to fight on its own turf. Rather than being the only alternative, it's now one of the number of its alternatives. Again, Tesla's a complex business because you then add the energy business. Think about the batteries, the power walls, and that kind of stuff. I've got a Powerwall 1 in my house. That's, again, what does this business look like? Is it an energy company? Is it a battery company? Is it a car company? Is it all three? Is it none of those? That's the real challenge. And so investors who have bid this up, and frankly, it's still pretty expensive as a car company on car company multiples. Ford and GM are trading on single-digit price earnings multiples, and Tesla, last I checked, was 30-something. So a really big gap. If it can continue to grow, then that's probably going to be justified. If it can't, that's the big risk. And that's why Tesla shares fell about 8% after hours trade this morning in the US on some disappointing sales and profit numbers, underscoring that point, which is things are now getting really hard. They got the early wins when they were there by themselves. The early adopters wanted it. Tesla's super cool. Great cars, too, if you've seen one. They're amazing. And now, what happens next? That's what's happening there. Alphabet's story is really interesting. When you look at they did 89, I think it was 89, billion US dollars in revenue, forget this, 3 months. $30 billion a month US. So I would call that, 45 billion Australian dollars a month in revenue. It's astonishing. And not only is that big, they grew at 14% year on year. So that's been a really amazing success story, continuing to grow. The old line, elephants can't dance. I don't know, Alphabet and plenty of other big guys, Apple, Amazon, they're doing an amazing job of being massive and continuing to get larger. NVIDIA, I should mention that one. We've talked about that before on the show. It's been an amazing story. The challenge for Alphabet is they couldn't grow profits. Top line up 14%, profit basically level with last year. Now, there's some marketing in there. There is some development cost. There is, frankly, we talked about inflation before. There's a whole lot of inflated costs. They're investing hand over fist in data centers for the rise of AI. The AI, we talk about NVIDIA, now computing power, the number of servers, the sheer bulk of computing power, not just the energy required, the number of servers required, the number of data centers required. This is just exploding, absolutely exploding. So that's Alphabet's challenge is, we're getting top line growth, search and cloud in particular doing really well for them, but can you turn that into bottom line growth? At the moment for Alphabet, the answer is no. And so that's when we talked about Australian earnings season. Not everything's going to be like Alphabet for a million different reasons, but that's something we're looking at. Top line growth used to be enough. When there's no inflation, if you get 10% top line growth, you can be pretty sure that 9 or 10% of that was profit growth, right? These days, if you're getting a 5% sales growth, that's probably just passing on higher costs. So there's not necessarily any more profit that comes with it. That's the challenge for Alphabet, and that's going to be one of the things we're looking out for this earnings season.
All right. Now, I want to get your thoughts on this. Until last week sometime, I was quite a happy owner of a few CrowdStrike shares.
Oh, no. Oh, okay.
And all of a sudden, CrowdStrike has become a household name, biggest internet outage in the world to date, apparently. Look, as an ex-software developer, the actual issue caused by the software, it was such a simple fix. All you had to do was go to the workstation, reboot it in safe mode, delete a certain file, reboot it again, and it's going to work. But the world doesn't work that way. We don't give average line workers who have these terminals, and these are terminals in airports and, coffee shop, franchises and things like that. So it did cause a lot of problems. It happened at the worst possible time, coming into a weekend. Are my CrowdStrike shares basically just going to plummet down to zero? I mean, CrowdStrike has 22,000 customers. I was a big fan before all of this happened. Personally, I don't think that it changes much, but will this damage to the reputation have long-term impacts?
That's the big question, mate. I think everything else you said up to that point is spot on, and your question is also spot on, right? By the way, I just came back from 3 weeks leave, as you well know. Our members may not know. Great thing I said to our platinum members today. The good news was no one realised I was gone. The bad news is no one realised I was gone. So I'm not sure what to say about that. But the good news is the team did a wonderful job in my absence. I drove through country New South Wales, and I stopped at 2 service stations on the way back home, and one of them couldn't actually release. When you go to a servo and they have to press the button to let you start pumping fuel, they couldn't do that from inside the shop. They just the systems weren't working, and this is Monday. So this was kind of 3 days afterwards. They still hadn't solved that problem. A second one I went to, the same day. On the point of sale terminal where you see what you've bought and what the price is, it had the Windows logo. That was it. It was just frozen there. It's like, I know what's going on there. So look, those things are very real, as you say, at a customer level, and that is the reputation question. I kind of think about probably some of the parallels of things like the Optus hack, for example, or the Medibank hack. Customers who said, you know what, Optus, got hacked. I'm not going to use Optus anymore. I'll change to Telstra. I'll go and do something else. That's the kind of reputational challenge some of these businesses are going to face. And it's not a case of they're not going to go to zero, mate. No, is the good news. Well, I can't promise anything. I can't make those predictions, actually, but very, very, very unlikely it goes to zero. But what the question really is what does it do? Think about the company's future, right? You would have had a view either literally or just mentally of, I think it's going to keep growing over time because there are going to be more customers who need CrowdStrike's products. They're going to spend more money on it. CrowdStrike going to keep those customers, add more to it. I can see sales and profits growing over time. And on a reasonable level, right? Maybe it's 10%, maybe it's 15%, 20% a year, whatever those numbers might have been. The question now is how many of those 22,000 customers leave CrowdStrike, rationally or otherwise? Here's the thing. My view on Optus was always the company least likely to be hacked is the one that just was. Why? Because everybody's focusing on that. If you're at Optus, you're like, this better not happen again. If you're at CrowdStrike, you better believe there's going to be 85,000 people who check the next software rollout before it's released, right? Because they can't afford to have it happen again. So kind of somewhat contrarian, in a contrarian fashion, you almost want to go with the mob who've just had the problem because they are going to be so focused on it. But some companies won't. Some companies will take the easy option. The board of directors will sit around and go, you know what, CrowdStrike's probably fine. But if it happens again, we're going to look silly for staying with CrowdStrike. So let's leave and go to somebody else. And that's a very possible set of outcomes for some of those companies. Again, for completely, frankly, not totally irrational reasons, but pretty irrational reasons. For kind of simplicity and for ease. Let's just change because then we can at least say we've changed. We've done something about it. We're seen to have acted. And these days, where optics kind of rules reality, some companies will do that. And so it's very possible that CrowdStrike's growth trajectory, firstly, it might lose some customers, so maybe it goes from 22,000 to whatever number. And then new customers who go to sign up who say, you know what, I really need some of that stuff that CrowdStrike's doing. Which ones will I look at? And some will absolutely say, do I go with CrowdStrike? Weren't they the ones that, oh yeah, those ones. Oh, we'll go with someone else. So I wouldn't be surprised in the short to medium term, mate, if I think it's completely irrational. If I was a customer, I'd happily stay with CrowdStrike personally. Not because I'm an IT expert, just on the game theory basis of who cares most, CrowdStrike right now. So I'd stay with them. But some will leave. That being said, if I was a betting man, mate, this is going to be a growth industry for a very, very, very long time. The simple reality of the sorts of protections that CrowdStrike usually provides. And here's the other thing. They've probably saved companies multiples of whatever it cost them when they had that outage in protection from malicious actors in the past, right? You don't see that. We don't see the things that don't happen. You speak about being a software developer, mate. When do people pay attention to IT teams? Not the 364.5 days a year when everything's working perfectly. You don't ring up and say, thanks, IT guys, the systems are up again. We love that, thank you. It's the one time when they go down where all hell breaks loose and everyone wants to blame the poor techies. So look, I don't have a particularly informed view of CrowdStrike's near-term future. What I would say is I think the trends that have seen it do particularly well as a business, let alone as a share price, they're not going anywhere anytime soon. I don't see a huge exodus. I don't see huge long-term reputational damage. The risks are elevated, I will say that. If there's a second one from CrowdStrike, those people who said, well, hang around, fool me once, shame on you, fool me twice, shame on me type stuff, at some point they're going to say, well, that's twice, guys, now we're out of here. So the stakes are absolutely much, much higher for CrowdStrike and its shareholders. That being said, the share price fell as a result. So you're getting a cheaper price or you're holding at a cheaper price. When you factor that in, again, no predictions, but I wouldn't be rushing to sell my CrowdStrike shares if I own them.
Yep, and fair enough. I won't be doing that. I'm a long-term investor. So yeah, speaking about your big 3-week journey across the country, it's good for us to get out of our caves and away from screens, and often out and about in the world. You see, economic investors out in the real organic world. Cranes on the skyline of a city will be an economic indicator. Did you see anything or experience anything that kind of gave you some indication of how things are traveling out there in the real world?
Yeah. Firstly, can I say thank you to the half a dozen or 7 people that actually come and said good day while I was on my travels. You asked me this morning, did I hear from any other people? I met some great people all over the place in campsites, on the sides of roads, on a walk through one of the gorges in the Kimberley. I went up to Broome via the Kimberley in WA, and met a whole heap of great people who recognised me from here or from TV or whatever. So thanks for saying good day. If you're watching now, thank you for coming to say good day. It was always fun. Mate, when it comes to the broader economy, what I thought was really interesting is things seem a little bit subdued out there, really honestly. I was speaking to some of the tourism operators up at the Kimberley. They were doing okay, but not as well as they have in the past. Now, some of that, I mentioned the COVID echo. There was a lot of people who got out and traveled for the last 2 years. And maybe some people got it out of their blood, or they kind of caught up the so-called revenge travel or revenge spending. People went, well, I've been locked up for so long, I'm going to go and do this thing and spend that money. That happened over the past couple of years. So there is probably a not unsurprising drop back. But I will say most places were saying, when I asked them, I kind of, because I do this for a quid, I'm interested. I don't want to pry anyone's business, but I generally say, oh, how's business? How are things going? So yeah, good, but not great is the general view on most of the places. I was a little bit surprised I could book some last minute accommodation in plenty of places. I think all but one place I tried as I was coming back, I kind of just booked either the next day or that morning for that night. Almost everywhere had space. The last motel I stayed at was in Hay in New South Wales. So g'day if you're watching from Hay. The motel there looked like only about maybe 25 or 35% of the rooms looked like they had someone in them. It was a motel, so you can kind of see because there's cars out the front and lights on. Only about a third of the rooms roughly looked used. Now Sunday night, so take it for what you will. But yeah, it wasn't terrible. No one was complaining, but there was capacity in plenty of places, and the people I spoke to were saying that things were better this time last year. A bit disappointing, but not terrible, which is kind of almost exactly what the RBA is looking for, right? If you had to ask them to describe it, that's exactly what they'd say. Is not terrible, just a little bit less than last year. So maybe they're getting what they want. Hopefully for those businesses, they've got enough, kind of capacity to stay afloat and kind of make it through this period. That's the big risk. Speaking of unemployment, if we do have businesses who let people go, that becomes its own snowball, and that's the real economic risk in terms of everything from economic growth, house prices, people defaulting on mortgages. That kind of worst case snowball happens only if, or almost only if, unemployment tends to continues to rise. So that's what I'm keeping an eye on. But to answer your question, I think okay, good-ish, but not as good as it has been, and just extra capacity in places you wouldn't have expected. People can tend to go north for the winter. Weather was beautiful, by the way. I live in Barrel. It's very cold here at the moment, so it was nice to have 16-degree nights and 28, 30-degree days. But yeah, it was a little bit quieter than most people would have thought.
Yeah, and look, you mentioned that you tend to ask people, oh, how's business? And that's something I think all investors, people who are interested in business should be doing. I learned how to do that from my predecessor, Bruce Jackson. He would always ask everyone and anyone how business was. That question was actually how I ended up here. So lots can happen just when you're out and about and talking to people, and you do learn a lot. So highly recommended. Follow-up question from Hassan back to Telix. There was a convertible bonds issue which impacted the share price. Are you able to just really briefly explain what convertible bonds are?
Welcome to the convertible bond half hour. No, I'm kidding. So look, so when companies need to raise money to do whatever they're going to do, we think about it in two different ways. We think about debt, i.e. borrowing money from the bank or other lenders, right? I want to go and start a lemonade stand. I'll borrow $100 from Adam. I'll go and buy some lemonade and some lemons and whatever else, and I'll start a lemonade stand. I've got to pay him back. If I don't pay him back, he's going to say, well, Scott, I'll take your assets and I'll put you in liquidation. So that's debt is great in the sense that I don't have to dilute my ownership. I own 100% of the lemonade stand. If it goes well, I keep it all. I pay back the debt, but I keep all the upside, right? That's great. The downside is Adam can say, you haven't paid me back. We had a deal. I want the money back. So that's a big deal, right? That's where debt's beneficial, but also where it can be costly and really risky. Mighty Craft, I mentioned already, simply couldn't pay its debts. That's why it went into administration. The other option is equity, and I'll get to convertible bonds in a sec because it's it'll be clear why I'm explaining it. Equity is great because you don't even have to pay it back. If you're a company, I've got my lemonade stand. I say to Adam, mate, I want to start a lemonade stand. I want to borrow money from you. What I'll do, you give me $100, I'll give you half the lemonade stand. So half the profits forever go to you. Now, good news is, if the company sucks, I don't lose the money. I don't have to pay the money back. The company just folds, right? Adam loses his investment, I lose my investment, but there's no debt to be repaid. The bad news is, if the company becomes the next, we're talking about Alphabet. So let's say Alphabet buys my lemonade stand for $84 billion. I've got to give $42 billion of that to Adam because he owns half the business. Now, if I just paid back the $100, I don't have to pay back $100, rather losing $42 billion of upside if it goes really, really well. So there you get the kind of the benefits and the drawbacks of debt and equity. There's no single best solution, depends on the circumstance. A convertible bond is literally, almost exactly anyway, halfway between the two. So it's a bond. That is a debt instrument. You are lending money. In this case, someone's lending money to Telix and saying, here's whatever they want, $100, we'll call it for fun of it. Here's $100, pay me back when you're finished. Or you can convert that bond, hence convertible, into shares. So rather than paying the $100 back, you can give me, and I'll make some numbers up here, you can give me 100 Telix shares instead. And often either the lender, the person who's lending the money, has the choice of which one they want, or the company who's borrowing the money has the choice. And so at some point, I don't know the Telix situation specifically, Hassan, so apologies, I can't tell you specifically in that case what's going on. I would suspect by the phrasing of your question, Telix has converted some of that debt to equity. And so in doing so, what they've done is said to the lenders, I'm not going to give you the money back. You can have some shares instead and we'll call it even. Now, from Telix's perspective, that means they keep the cash. So they've got more cash on hand, better if they want to use that money for something else. But as a shareholder, they've just chopped the company up into larger pieces or smaller pieces, given away more pieces of that. So let's say I had the $100 from Adam and it was a convertible bond. Adam says, actually, Scott, or maybe I say as a lemonade stand owner, and I'm not going to pay back the $100. Instead of that, you can have 25% of the company. And that's kind of what, if it gets converted to equity, and again, I'm only presuming, Hassan, based on the question, if that's what happened with Telix's case, all of a sudden I own less of the lemonade stand than I used to. And so my ownership stake is smaller. And therefore the value of the shares I own the same number of shares, but I created some more and gave them to Adam. So my shareholding per share is worth less. The stands were still worth $200. Adam now owns 25% of it. So my shares are now worth 25% less than they were before I converted that debt or that bond to equity and gave Adam the shares. Hope that's okay. It's a bit arcane. It's a bit theoretical. I hope I explain it reasonably well. It's a really great question, mate, because it's one of those things that investors really need to pay attention to. If you looked at earnings per share yesterday and said, well, there's a certain number of shares, certain number of earnings, I can do those maths. If there's more shares today, the earnings per share falls. Earnings don't change. The number of shares goes up. And so you own less of the company than you used to. It's one of those things you really need to look out for as an investor. I'm not saying it's bad. I'm not saying Telix is not doing the right thing or it's not worth investing in. I'm just saying when you do any of those maths, make sure you understand if there are convertible bonds out there, because that can happen to the share price.
Yeah, just another form of dilution, which is something that we want to pay careful attention to.
Correct, lovely.
Okay, question from Ask the Fool. With all the talk of nuclear energy recently, I'm wondering if there are any recommendations of Australian companies to invest in.
Oh, that's a really good one. So I'll just say quickly, if you're a member of Motley Fool, most people watching hopefully are, if you go to the member centre, which is fool.com.au/member-centre, pretty straightforward, our website /member centre, member-centre. The little Ask the Fool buttons at the top in the menu bar, click on that, and you can throw us your questions. It's how Adam got these ones. So I hope you don't mind me mentioning that, Adam, just a way of people getting in touch with us and getting that information. Nuclear is hard, right? So you're asking, what can I invest in? And it kind of, the answer is it depends what happens next. And I know that sounds silly, right? There are plenty of, or not plenty of, there are a few uranium plays on the ASX right now. Deep Yellow is probably the longest one, I think. There's probably another one I think out there. I can't bring it to mind right now. If nuclear continues to take off, if these companies can mine uranium successfully, if they can commercially produce it in large enough quantities, and if the shares are pretty reasonably valued compared to all that, then maybe there's some upside. And I don't mean to poo-poo the idea at all. My point is more that just because there might be more nuclear energy, it's a very, very, very big jump between that and therefore you should buy this company. So yes, there are uranium miners on the ASX. If you have a belief, go for it. I just want to warn, it reminds, I've talked about ETFs before in this vein. Just because the theme is real doesn't mean there's necessarily money to be made. My favorite, Adam, you'll be already rolling your eyes here, is the airline industry. If you'd have told me 50 years ago in 1974 that the number of airline seats, the number of airline passenger miles flown over the next half century was going to be what it is today, I would have sold my house, sold my car, sold my kid, and bought airline shares because, oh my God, airline travel is going to go up 10,000-fold, whatever the number ended up being. Prices are going to come down. It's going to be amazing. Everyone's going to fly everywhere. And again, think about this, 1970-something, it's only the really rich people who flew, where you flew once to go from one country to another as an immigrant. These days, we know what people are doing flying-wise, right? So, hey, how can it not make sense to buy airline shares? Of course you would. Unfortunately, as we know, even though the trend was right, it wasn't even the trend was wrong. It was literally right. They were spot on. Airline travel was going to explode. And yet, the airline industry as a whole has sucked horribly over the past 50 years. Most US airlines have been broke 2 or 3 times. Qantas is doing kind of okay. It's still below the takeover price that was made by Jeff Dixon in, was it 90-something? I can't remember now, like decades ago. It's an awful, awful industry. Not because travel has not exploded, it has, but because the maths, the economics of the industry and the airlines simply weren't there. I raise that not to say uranium is going to go badly at all. I don't have a view. What I know is that historically, we haven't been able to just to say, I think nuclear will grow, therefore we should buy uranium companies. So that's the one thing you need to be a little bit careful of when it comes to that. Now, that being said, I will share with you, and the question was asked, so I hope you don't mind, Adam, but I will share Extreme Opportunities we talked about before. The guys there, Trevor and the team at Extreme Opportunities have recommended an ETF called the Beta Shares Global Uranium ETF. It's on the ASX under the code URNM. That is an ETF that comprises a whole lot of uranium miners and nuclear energy proponents. You'd have to look at the details. It's not one I own. It's not one I've done a whole lot of detail recently, but they recommended that a few months ago. I'm trying to get the details so I can share it with our members.
Yep. Full disclosure, I actually own units of that ETF.
There you go.
And
nice.
But I will remind you that we call the service Extreme Opportunities for a reason. So.
Exactly. Hey, that's actually a really, really good point, mate, because you're right. They're not recommending it because it's a slam dunk. Extreme Opportunities aims to, this going to sound silly, right? And this is not an ad, by the way. They aim to be wrong more than right. So hang on, why would you aim to be wrong more than right? And I want to remind our members and our viewers of venture capital. So the VC funds that go and try and find the next Facebook or the next whatever, they know that they're going to be wrong more often than not. In fact, the mob that I think was one of the major investors in Facebook was right about 1 time in 20. They're wrong 19 times out of 20, or wrong in air quotes, right? Modest, mediocre, terrible, average returns, whatever. 19 times out of 20, because they only need one Facebook to do really, really well. Now, Extreme Opportunities are trying for more than 1 out of 20. About 4 out of 10 is what they reckon they'll probably end up doing. What that means, they're looking for big outsized opportunities. I mentioned Telix before. They recommended that twice in 12 months. That's when it goes really, really well. They expect some to go badly, not because they want it to, because they know that's the way the game is played. You can't just buy Facebook and ignore everything else, because no one knows when Facebook is just Mark Zuckerberg in a college dorm room. No one looks at Facebook and goes, aha, this is I'm going to sell everything else just by Facebook. It's the one company that's going to go spectacularly well. What they do is say, I don't know, Facebook was interesting. So does MySpace. So does, were you on schoolfriends.com.au, Adam? I certainly was back in the day.
No, too young for that, Scott, I'm afraid.
Be nice. So, it could have been any one of those, right? It happens to be Facebook. They just didn't just invest in social media companies, but think of all of the different options that you could have invested in. Some did really, really spectacularly well at Facebook. Most did average-ish. A lot went to zero, literally to zero, and they just wrote the investment off. Extreme opportunities, it's not that extreme as VC, but it's that style. They're looking for big 10-baggers, things that can go up 10 times in value, knowing that many won't. And that's the deal you make with yourself. If you're that sort of investor, that's what EO tries to do. If you're not, please don't join Extreme Opportunities. It's not for you. Don't people who say, I picked one of you, I bought one of the companies you recommended, it went terribly, and you guys suck. That's not what we're trying to do, right? In fact, any of our services, by the way, but certainly not in EO. We're trying to say, spread your bets, find things with huge upside potential, but with low probabilities. When they do hit that as jackpots, like a Telix or like a Pro Medicus at Hidden Gems, the returns are phenomenal. So that's kind of a worked example of why we do what we do and how we think about it. So yes, uranium ETF. I personally still on the sidelines on this one. I got to say, I know you own it, and Trevor likes it a lot. For me, I'm just like, I don't know. I just don't know. And so as an investor, I'm not an extreme opportunity style investor. I'm not a moonshot investor, and that's not bad. Just not my style. Great example in the US, David Gardner, our co-founder, runs Rule Breakers over. Used to run Rule Breakers over there. It was the #1 performing newsletter, right? Massive extreme opportunity style investing over a 5-year period up until, I'm dating myself now. It might have been 2015, 16, something like that. At the same time, the second best performing investment newsletter in America was another Motley Fool one, Inside Value. So we've got this, massive hyper growth idea. And this other one, which is like just value investing, looking for cheap stuff, undervalued, all that kind of thing. Extreme opposite ends of the investing spectrum. And yet they were #1 and #2. My point is there are different ways to skin the cat based on what you're looking for, based on your risk appetite, based on the way you invest. So that's worth looking at. Nuclear, maybe it's huge, maybe it's not. Maybe it gets taken up, maybe it doesn't. Maybe it's a fad. Maybe SMRs take off. I don't know, no one else does. I would recommend to everybody, don't invest based on politics, don't invest based on ideology. Invest on the basis of what you think will happen, but based on realistic expectations. Not it should happen. If you're pro-nuclear just because you think it's the right technology, that's fine. Doesn't mean it necessarily will happen. Or, again, as I said with airlines, even if it does happen, doesn't mean necessarily there'll be money to be made. So consider it a higher risk investment opportunity if you're going to do it. An ETF is a great way to spread your bets across there. There are some Australian ones. Deep Yellow is one, and the other one I really can't remember. I will try and Google very quickly, Adam, because it is bugging me. Yeah, those are the two ideas I think to have a bit of a think about if you're interested.
I will say that the uranium ETF has been a bit of a wild ride for an ETF. So,
has it? Okay.
Yeah, make sure your risk tolerance is very high. Or sorry, volatility tolerance is very high if you're going to buy into that one.
I can imagine, mate. One quick one. This is boring. Deep Yellow was one I mentioned. Boss Energy is another one in that space. Yeah, they're the two I was thinking of. Boss Energy and Deep Yellow. Or the ETF. If you asked me if you made me make an investment in uranium right now, I'd go the ETF.
All right, there you have it. And that is about all we have time for. Do you have any closing comments before we wrap it up, Scott?
Yeah, earnings season can be a really, really volatile time. Share prices will move all over the place. The last few years, we've seen when companies disappoint, their shares can get absolutely smashed. We see a lot of, I think it's probably partly algorithmic selling, honestly, where we see shares fall 20 or 30%. That's not a reason not to invest. It's not a reason to go to cash. Don't mishear me. What I want you to know, though, is that these things will happen. Things will be volatile. Things will be messy. Hopefully, by the way, you'll own some stocks to go up as well. So we want them to go both directions. Well, we want them to go up, obviously. But if it's going to go, some are going to go down. We hope some go up as well. Just be mindful of the fact that the market's reaction doesn't necessarily tell you how to think. If it did, you'd only ever buy an ETF and go fishing, right? If you're going to pick stocks, you want to find areas where the market is wrong. When you get the earnings, think about what management are trying to tell you and discount any hyperbole or any salesmanship. Think about why you own the companies that you own. Has anything really changed, or has the share price just moved? Really, like on a long-term, 5-year plus basis, is this company really going to be worse in 5 years' time because of these results, or is it going to be meaningfully better in 5 years' time because of these results? take the long-term perspective and put those short-term results into that context before you make those decisions. Also, don't forget, don't try and overtrade this thing. Someone with a hyper-speed computer is going to beat you to the trade. So think long-term, stay long-term, focus on the business itself. Yes, take the earnings, put them in the context of the business's track record, the trajectory, what it's trying to do, how well it's getting there. That's your best starting point. Make hay slowly is probably the best bit of advice. Just think deeply, sit with stuff, really understand what you own before earnings season starts too, by the way. If you're not sure why you own something or you're not sure you like it, now's a great time to clean out your portfolio. Not because you're trying to front run any potential bad news, because it could be potential good news. Just really ask yourself, should I really own this? Do I really know why I own it? Do I really know what to expect? Am I going to be confident owning it if the market share, the price falls 10% because the market hates the earnings? Am I going to still be comfortable with it, or am I going to sell it at that point and crystallize a big loss just because all of a sudden I realize my conviction is not what it should be?
Great advice, Scott. Thank you. I'll be following that myself. Thanks for joining us, and thank you, viewers, for joining us, and we'll see you next time.
Full on.